And now we move on to the panel session. Macroeconomics, economic factors impacting consumer markets. And so we're going to be looking at the implications on our respective consumption patterns. We have an A-list panel who will be dissecting those issues. And the first panelist is the MD of Crimson Oak Partners. His name is Besson Olatunji. Please welcome Mr. Besson Olatunji. Mr. Besson Olatunji will be the moderator of the panel. And the panelists are the Deputy Managing Director of AfriInvest West Africa, Mr. Victor Ndukauba. Mr. Ndukauba, please, if you're here, you can come up stage now. Please put your hands together for him. AfriInvest is a leading investment bank in Nigeria, and they're one of the top 5 in that sector. The next panelist is the finance controller at Unilever, a household name that we all grew up knowing, and they're still doing great things. It's the home of Close Up. We have the finance controller, Modupe Femi Okubanjo. Thank you. Next panelist is on radio every Monday on Classic FM. He runs a podcast, he hosts a podcast, and he's the brain behind Nigeria's foremost finance publication online. Ugodre Obichukwu, the founder of Nairametrics. Please put your hands together for him. And the last but not the least was our lecturer who delivered an excellent keynote address. He's the CEO of Boson's Group PLC, Narendra Nagaka. You're welcome back to the classroom where he just finished delivering a lecture. It's now my pleasure to bring on stage the moderator and to hand over the microphone to him. Besson Olatunji deserves your applause. Everybody has a microphone? Good? All right. Let the panel begin now.
All right, good morning, everyone. Is it too cold in the room? So again, good morning, everyone. Are we excited to be here? So could you just look to your right and to your left and just welcome someone beside you? In case you've not had enough time to socialize with someone. Okay. So it's great to be here this morning, and I think that for those of us that followed through the keynote address, you would readily agree with me that it was such a deep dive into a lot of the issues that we face on a day-to-day basis. And you know, for us finance people, those of us in your front right now, right, we perhaps would have maybe wanted a bit of more emphasis on the financial side of things. But you should see what our keynote speaker did was to show us the financial part without making a lot of noise about it, right? So this session, we'll be having a lot of conversation around some of those critical touch points that affect all that we do as retail people and manufacturers. And I think I would like to start off with Victor. So particularly for West Africa, one of the biggest issues that we've faced is the divergent inflation rate. So particularly for Nigeria, it's about 22.97%. For Ghana, it's about 18.4%. Now, so how has this divergent inflation rate really shaped the regional market attractiveness for consumer markets?
Okay. Well, good morning, everyone. It's a pleasure to be here. I think that's a very loaded question in the sense that while inflation typically would shape a number of decisions, in the current climate we're in, which is a global picture where there's a lot of trigger points of instability, we have very short-term distortions in inflation that create very significant spikes. The thing with businesses is that nobody makes long-term business decisions on short-term events. We've had high inflation for the last 2 years, occasioned by a number of critical factors, not the least of which is the conflict that took off in Ukraine with Russia's invasion, and now more recently, the issues around the attacks by Israel in Iraq. Now, when businesses make decisions around product pricing, product distribution, while inflation would typically force their hand around product pricing because it impacts on costs, ultimately, there are several other factors that then determine how you ultimately make or how you ultimately decide to play. You look at the size of the market, you look at the per capita income, the purchasing power, you look at demographics, you look at the operating costs. And I think the presentation was particularly spot on when it touched on some of the factors that drive inflation in Nigeria. One of that, obviously, is on the logistics side. I've always maintained that inflation in Nigeria is more systemic and infrastructure driven than not. It is less monetary and it is more about the lack of infrastructure. So ultimately, when we look at the region, West Africa, for example, so as much as inflation in Ghana, for example, is lower today than Nigeria, it historically has actually been the reverse. Again, this is a short-term distortion. So what would then determine how operators or companies or manufacturers would play would not just be that inflation factor, but several other things around the macroeconomic, socio-political stability. It will be around, for example, incentives around investments, how you position for capex, any incentives around manufacturing, the state of the infrastructure, favorable fiscal regimes around taxes and how those impact on product pricing and exports, and other factors of that nature. So it's a pretty complicated conversation, and it's not one that would just be premised on inflation alone.
Can we appreciate Victor? And I mean, I think that from what Victor has said, it's quite evident that making decision is not short term. So really, there's a lot of consideration that has to be put in place. And sadly, for a lot of consumer good companies, right, you always have to try to beat the curve. So because of the ever-changing inflation rates, strategies keep changing from time to time. All right, so I think I'll go to Ugo Dre. And just picking up from where Victor stopped. So we've spoken about inflation rate. But more evidently, currency volatility still remains a major challenge that a lot of African countries are facing, Nigeria, Ghana in particular. Now, from your perspective, listening to you over a period of time, which hedging strategies are more effective for import-dependent consumer good companies when you look at the ever-changing currency fluctuation crisis that West African countries are facing?
All right, thank you very much, and good morning, everyone. Thanks for having me here. I think over the last better part of the last decade, I think we've seen different facets of the economy go through different challenges. We've seen different cycles of bust. Some would always tell you it was a lost decade. And I mean, track back from 2014-15, when all this started. We had that currency crisis of 2016-17. We then had a stability between 2018 and 19, and then COVID happened, and then we fell into another, crisis. And then as we were getting out of that, the so-called, capital flight happened around 2022. And then 2023, as it looks as if we were probably getting back again, and then you had the famous subsidies removed and all that. So I think businesses have a lot of history, and they've tried different things. But here's what we've seen that appears to be working, or what most of them are doing now. You would always talk about the conventional forex swaps and all this, financial hedging techniques. But businesses in Nigeria, particularly FMCGs and even manufacturers, and even businesses that buy up companies, have also learned that, look, you know what, as much as all these hedging techniques work, this is Nigeria. Nigeria is just a very peculiar market. And so from changing from borrowing in dollars, so typically, if you wanted to maybe acquire an asset or maybe procure goods from abroad, because you think that the goods you're buying abroad, you pay for it in dollars, so it probably makes sense for you to borrow in dollars. People have realized that actually doesn't even make any sense. So what a lot of smart businesses are doing now is like, you know what, I'd rather just borrow in naira and then convert to dollars. So at least I know my borrowing cost is in naira, right? And so the only thing I need to worry about is my naira interest rate. And then convert to dollars and then probably procure. Now, some are also basically rethinking their procurement strategy. So a lot of people are localizing as well. So rather than, focus on foreign imports, you're looking for local partners that you can basically empower. You're even seeing some manufacturers even empowering local suppliers, giving them loans, because they know these guys are probably good at, local supplies or local manufacturing inputs. So why not just give them the financing they need so that they can do that? Because that hedges against foreign currency, costs. So we're seeing them take some of those strategies as well. Then the one that I know that a lot of us also do, if you're not doing it, you better start doing it now. You're seeing a lot of businesses say, you know what, yes, we're no longer in that currency volatility space again. I think we've been around 1.5, 1.6, and it's kind of predictable now. And that's what businesses always want anyways. But even at that, you're seeing a lot of people say, you know what, let me just use 2,000 naira as my exchange rate and price my goods like that, right? So that whatever happens, I'm still covered. But I guess what they also need to do is not spend that buffer, because what tends to happen is that you forget that you created a buffer for yourself. You know exchange rate is 1.6, but you've priced your cost at about 2,000. So that difference is meant to be some sort of buffer whenever such currency volatility or such exchange rate depreciation crystallizes. So these are just some of the practical things that businesses are doing, and I think it's been working for them. And if you've noticed, a lot of at least from some of the published financial statements that we've seen, you've seen businesses are now, you've seen their top line revenue increasing, which is also another strategy, revenue prices. I've always told people, don't be afraid to increase your price. Don't be, right? So if you can adjust your price, especially where you have an inflationary environment, don't waste your time, adjust your price. Of course, you also got to look at your competition. Yeah. So adjust your price, look at your competition, and then look at the quality of the product. And what's also important is that you've also seen that because of the change in dynamics of our economy, local businesses can now compete better, because it's a lot more, in fact, it's not even currency volatility that's the issue, it's even accessing FX is also a problem. So you've seen that a lot of importers find it difficult to access FX, and so they can't really import as much as they can. So they can't also compete as easily as they used to with local manufacturers. So local manufacturers have that advantage, and so they can compete better. So back to what I was saying. So you've seen a lot of manufacturers increase prices. You've also seen them now start to fix their balance sheets. You're also seeing operating margins increasing. You're seeing them decline operating profits. So they've also learned the hard way, and I think that is likely going to be what we'll see over the next few years. Businesses that can now adapt and understand that, look, we're now in an environment where you can't just hedge or you can't just allow your business to depend solely on imports for your inputs. Yeah.
Can we appreciate the good Dre? All right, so I think I will go to our guest speaker, Mr. Narendra. From a more practical perspective, right, you are in the field, you are in the market, and I'm so sure that at different points in time, you must have been hit by the FX volatility. Now, from a more practical perspective, how has your business been able to hedge this risk? Hugo Dre spoke about pricing as a strategy. Literally make provisions for the FX fluctuation and then increase your prices to accommodate the provision you've made. Now, from a more practical perspective, how have you hedged in your business and what has been the market reaction when you increased your prices?
To be honest, I think it's a very tough question because it's easier said. The steps that you have presented sounds very simple, that I can increase my price. When I start saying I increase, my team starts throwing stones at me. So it's not at all easy. I think the last, post-COVID, if I may say, post-COVID, we saw the golden period of COVID, FY22. I think it was the best year for most of the companies. And then reality struck. And since then, we have been trying to hedge, create buffers, try to increase prices. But there are two factors to it. One is the consumer, second is the competition. So the two C's hit you. The consumer's pay packet did not change for a long time.
Yeah.
It has started changing now, it's a positive sign, but for the period that we are discussing, it was a very, very tough time for all of us. And even if I increase and the market accepts it, but if the competition is not increased for whatever reasons, I'm sure they have their logical reasons for that, I stand in a corner with my flag and no followers for me. So it's been, if I may put it in the right way, we have failed, to be honest. It's not something that I'm very proud of, but it's not been a smooth journey for any of us. I'm sure anybody connected to the FMCG field here would relate to this, especially the giants like Unilever. Yeah, it's been a tough journey, and there's no one-line answer for this. It's your judgment. It's how you feel the market, the timing, and how do you read your competition. I think these are the factors which have helped us cross this bridge. Thank you.
Thank you very much. And I think that's a very professional way of saying, find your answer yourself, right? It's such a very, very profound answer to say there's no one size fits it all. So you've got to really deep dive into your books and then try and look for what works for you. So yes, we agree that currencies are swinging and standing still is not an option. Do we all agree? So we have to constantly react. But again, so I'll go to Dupe now. And the conversation is going to literally center around how smart pricing and sharp segmentation can keep you winning. Now, how can granular market segmentation, such as urban versus rural distinction, income tiers, which everybody has spoken about largely, be leveraged to optimize SKU portfolios in an inflationary environment like ours?
Okay, thank you very much. And I would say good morning to everyone once again. And I want to appreciate the convener of this summit. I think it's the right time for us to have this summit, and I'm glad to be here sharing my own experience. Yes, I'm particularly delighted about, the presentations we had from Mr. Neranda. which shows that, of course, trends have changed. And looking at where we are now, and then in the environment in which we operate, it is important that we are able to break down the segment in which we operate. Gone are the days when we are looking at our portfolio as a total package. You have to break down that portfolio on an SKU basis. In fact, you have to drill down to understand the P&L, the profitability of your SKU, of each of your SKUs. And to achieve this, it is important as well that we break down our segments. Before now, we could look at the geographical segment and say, this is what the consumer wants in the north. This is the product that the consumers would buy in the west. But where we are now, the tastes of consumers are very fluid. And it is almost like you have to be on your toes to understand your consumers, because the interest of the consumer on street A can differ from the interest of your consumer in street B, So we have to go that granular and address your product to meet the need, the specific need of your consumer. It's inflationary period, disposable income, is reduced. Costs of producing your stock is increased, and you have to strike a balance. So how do you do this? You have to ensure that your product is available to the consumer who needs that product in the right place, in the right format, and at the right time. So all of these are key, segments that you have to break into. We're talking about, the lower income strata, that it's about 70%. But you'll be doing yourself a disfavor if you do not break down even the low-level income earners. The low-level income earner in the north is different from that in the west, different from what you have in the east, and different across the regions as well. So it is important that you drill down with data. Mr. Neranda talked a lot about data. Data gives insight. You are able to know, what is the interest of this low-level income. For instance, in Lagos, you can see a low-level income earner who is using an iPhone, for instance, which is considered a premium product. So it depends on taste. It depends on the preference. Depends on the culture, of your environment. So for us to win, or for businesses to win, you have to lean more on data and then be close to the market. You have to be close to the market, be on ground, be in the open market. It is high time we get our hands dirty and get into the market to understand exactly what the consumer wants. And with that, we'll be able to survive. That's the way to go.
Can we celebrate her? Can we appreciate her? Now, something very profound that she said is enough of the big boy strategy analysis that we do, armchair analysis, right? So there's a lot of need for data-driven insight in making decisions. And I think that even from a very more personal perspective, right, because I also work with a lot of businesses, I think that that's an approach that we are advising a lot of businesses to take. So quite unlike previous years, right, where we could literally do business the same way. Now, it feels more as if the market is determining what we should be doing. So it is the market giving you the insight, and then you react to that, rather than you trying to push what you are doing on the market. All right, great. So I think we'll go to Ugo Dre next. And I have a very interesting mix of questions. So she's largely spoken about disposable income, right, with people's earning thinning out, and the need for market segmentation, but also importantly, there's also the manufacturer's claim of the impact of high interest rate on their businesses, right? So it affects both the manufacturers and also the consumer. Now, do you still think that with all of these realities, pricing should be fair on people, or businesses should actually take account of their full cost and pass it on to people? So that's question number one. Then the question number two is, how then do businesses now create a balance between sales and also market reaction to their pricing?
You know, me, I'm not a socialist, too. So, to the extent that we are in a capitalist economy, right? Businesses will always seek for profit maximization, and I think it's something that we must protect. Businesses should always be encouraged to seek profit maximization, and that in itself leads to competition, it leads to innovation, and it leads to disruption. Because once you start to seek profit maximization, then you start to have, so long as, of course, there are no, you don't have a monopoly, and that's why you have government and regulation, people would compete. And what we've seen happen over and over and over and over again is, so long as there's healthy competition, prices always finds its level, just like water. What we shouldn't encourage is a situation where we try to stifle businesses from pricing their products appropriately just because we're trying to satisfy, maybe the masses or populace. And then you start to have businesses that are running at a loss, businesses that start to cut corners, businesses that start to compromise on their quality of products. And then what you don't actually understand is that when you start to do that, then you're inadvertently raising prices as well, because that you're basically selling a very poor quality product at an expensive price, even though the price might look cheap. So I don't agree with that. However, I think what we do need to do to encourage cheaper pricing is make sure that a lot of the structural challenges that impact businesses that we know government can fix, then fix it. Businesses want better road, they want access to electricity, cheaper electricity, they want lower taxes, lower regulations, economic stability, exchange rate stability or predictability, like we mentioned earlier. Once you have things like that, I think prices always tend to come down. And then government has better ways of also curbing excessive business practices. You can do that via taxation. You have further competition bureaus as well that can also go in and see that, or check malpractices or businesses that tend to overcompete or outcompete because of monopoly. So that would always be what I would suggest. And then for businesses, I guess we're in a market today where the consumers are very powerful. I think she mentioned that as well. Consumers are very price sensitive. Consumers these days, some of the things that we do at Nairametrics sometimes, we do market surveys, and you notice that consumers go to regular supermarket, whether it's ShopRite or Ebano, and once they see 2 bottles of water, nobody really cares to a large extent who manufactured the water. They just look at the price first. Abi? Yeah, exactly. They look at the price first. When they look at the price and they see that there's water that is inside and it is sealed and it is in a bottle, it's the cheaper one that they will go for. And I think businesses know this. And I remember in one of these sessions as well some years ago, I said that we were going to see businesses transition into PET water bottles. I always used to wonder why a lot of manufacturing companies were making water bottles that were, because what you find is that people just drink half of it or a quarter of it and leave it. And then you think that they're going to buy it the next time when you increase the prices. So now you're seeing businesses also understanding that, understanding the needs of the customer, which is also why you spoke about research and understanding what the customer needs and giving them that particular product the way they want it and at their price point. So I think these are just some of the things that smart businesses do and what they should continue to do. But please, businesses should always seek profit maximization, because that's the only way you can actually reinvest in your business and still achieve that lower pricing that we're looking for. Thank you.
All right, thank you very much. We can clap our hands because you're speaking our minds, Abby. All right, so I'll go to Narendra before coming to Victor, just to take off from what Victor said. Sorry, what Ugodre said. And he spoke about the need to domesticate product. Now, my question to you is, which consumer categories, essentials, value-added staples, or affordable luxuries, exhibit the greatest resilience to purchasing power erosion?
Sorry, can you please repeat? I didn't get the last part.
So which consumer categories, essentials, value-added staples, or affordable luxuries, exhibit the greatest resilience to purchasing power erosion?
I think the answer is in the question. It's the most, the top-end products do not have any barriers. You could put it in any segment. But when you're looking at the bottom of the pyramid, and let me take the example from my personal experience when we were selling pasta, Honeywell. As Madam rightly said, the behavior across the country is different based on geographies. So the importance of pasta in the north is different from the importance of pasta probably in the west and in the east. And that product in the north is so price sensitive because it directly competes with rice. And you know the situation in the north. I don't need to explain that. So it also depends on the geographies that we are catering to. It also depends on your target audience, where you're looking at. But broadly speaking, those products which are at the bottom of the pyramid are very sensitive. And that's why another example is because we use a lot of these, the 100 naira and the 50 naira currency notes. You will see that the grammage in the milk or in many other products, whether it is custard or any other product, the grammage changes because they have to maintain the price point. I mean, these are feelers which give us an indication that when you are at the bottom of the pyramid, the sensitivity is the maximum. And when you go towards the higher end products, it may not necessarily be zero, but yes, there is a level of flexibility there.
Thank you very much, Narendra. We will take some questions from the audience towards the end of this session. So if you've got questions that you'd like to ask, you can just start writing your questions down, then we'll take them at some point. So Victor, coming to you. I know you work in a very regulated environment and you interface with regulators a lot. And I know that some of the issues you face is the intersect between the policies and the actual realization of those policies and the impact on general businesses at large. So my question to you is, how do central banks' foreign exchange allocation policies, such as Nigeria's preferential rate for manufacturers, how does it distort market competition? So you know that for the very longest time, it felt as if there were preferential treatment to certain sectors of the economy. And you know that Hugo Dre spoke earlier about the need for fair competition amongst manufacturers. So these preferential treatments, particularly around FX allocation, how do you think it distorts the competitiveness of the market?
Thanks for that question. I think the The fact is that there was indeed a lot of distortion in the FX market, and it was quite pronounced under the former regime of the central bank. A lot of it was, for lack of a better term, it was labeled as demand management. Essentially, reduced FX income on the back of low oil exports, on the back of low oil prices meant that the country wasn't earning enough FX and therefore had to manage demand. And the approach the central bank took was, first of all, there was all of the separate interventions into different sectors, having dedicated financing at preferential interest rates to cater to the needs of these various sectors. Then, in addition, it then created this distortion with trying to give, okay, you know what, certain people will get access to FX at different rates. Now, what that did, in effect, was destroy the market. We had about 6 or 7 different rates. If you wanted to go on Hajj, on pilgrimage, there was one rate for you. If you're a petroleum importer, there's one rate. If you're importing pharmaceutical, what they call it, especially scare medication, one rate. If you were operating in manufacturing, one rate. If you wanted to go on holiday or medical. So that distortion essentially created a market where people who had access to FX, for example. Now, I will give you very specific examples. So I had this friend who had people in the Hajj Commission in Abuja. At the time, dollar was 360 officially in the retail market. It was available at 306 to those going for Hajj, right? Or you're going to Jerusalem. Then there was a segment for those who bring in, drugs for, cardiac patients or, tuberculosis patients or people who had cancer, at 330. So he would go with his friends, they will go and get the dollars allocated to them, ostensibly because you want to go on Hajj at 306, and then he will quickly go and flip it at 360. Right? You make 20% in the space of 24, 48 hours, and then you are back again. So when you create such preferential windows or multiple windows, what you're creating essentially is an inefficient system where the needs of the market don't get met, but a few people who have access abuse the system. Today, that has changed. With the coming on board of the new CBN governor, I think one of the things he very clearly communicated is that, look, all of that business of having to serve different segments would stop. What a lot of Nigerians erroneously refer to as floating of the naira was essentially just a removal and a collapse of all of those multiple windows into one market, essentially. So if there's anything you take away from here today, I can tell you categorically the naira is not floated. So just take it. Because if you float the currency, what you do is you'll find very wild swings in the rates in response to market forces. The moment, for example, Israel bombed Iraq, you would have seen the rates move again because oil prices have moved. So we have a bit of stability now because we have one market in FX. If you want FX, you go in there. Whether you're an importer, you're an IOC, you are an exporter, you're a manufacturer, you want your dollars, you supply. If you have access to dollars because you export goods abroad, you supply to that market, you get a rate. The other thing they've also done is leverage data. So, what makes markets more efficient is transparency. By introducing the B-match system, essentially anybody who has access to a Bloomberg terminal can see what the rate is today. At any point in time, you know what the rate is, you know what the margins are, and because the regulator provided very strict guidelines around how banks can operate, you cannot go long on currency. You are required to bid. You have a net open position that is 0, meaning whatever dollars you have as a bank, you must sell it into the market. The arbitrage opportunity is less than 1%. So today there is clarity around what you get when you need dollars. What that has done for Nigeria, on the positive side, is that we have a more liquid FX market today. Yes, the volumes available are not where it used to be 10 years ago in the sort of $45-50 billion a year, but at least at 25, 27, going on $30 billion, it's much better than where we're struggling to see $10 billion of supply into the market. Second thing, the impact of the B match has also meant that the CBN's need for intervention has also reduced significantly. On average, the CBN does not do more than 7 to 10% of supply into the FX market today. Now, what this means effectively is if you're an operator who has a genuine business need, you go into the FX markets, you have your Naira, you bid through your bank, and you get allocations. So in terms of markets and competition, what it does, therefore, is as long as you can plan your inventory, you can plan your procurement, sequence it again against your needs for manufacturing, understanding your consumer, your consumer market patterns, you can plan your demand for FX, sequence it to align with what it is you need to either procure your imports, if that's what you need, or if there are certain maybe capital equipment or items you need for the manufacturing process, you can also sequence all of that. And I think that's where we are. So when Ugo mentioned the fact that the markets are a lot more stable, that is exactly what has happened. And unless we go back to the old system, I think this provides clarity, provides direction, and it gives you room to plan and project, knowing that, look, the only factors that then shape the conversation would be what happens with things like oil prices, what happens with our production levels in terms of crude output. So to the extent you can improve output, or supply of crude oil, and oil prices remain stable or increase, like we've seen a sharp 7-8% spike in the last week because again of the conflict where Israel has invaded Iraq, and oil prices have gone from 67 average dollar to about 77.78 for the Brent. Then you are sure that, okay, you know what, there will be less pressure on government from the fiscal side. What does that mean? So if dollar revenues are higher because of a higher oil price, then it means that there's less propensity for the government to go borrowing to meet a budget shortfall. That less pressure from the public sector side means that businesses have less pressure on the pricing of interest rates and can better plan and access the markets.
Can we appreciate? It literally took us on a very short masterclass of how the FX market works, right? Okay, so I'll come to Mojupe. So you are in-house, you sit behind some of these numbers. In more recent times, right, this entire readjustment with the CBN, what has the impact been on your business firsthand? You sit back and you work within the system. Now, the more fluid FX regime that we're witnessing, access to more funding, what has been the direct impact on your business?
Thank you very much. I think it's been a better space in the last few months where we've seen the currency stabilize as much as possible, and then the CBN is also making a lot of effort to stabilize the interest rate as much as possible. What has this done for us? It has helped us to be able to forecast and to plan adequately. We are able to know what's going to be our FX requirements. You are able to at least predict the band in which you do not expect the FX to go beyond. Ugodre said something about, you may sometimes peg your price to say, oh, I do not expect FX to go beyond 1,700 or 1,800. So you are able to then plan effectively. You are able to, know where, the FX you require to fund your operations would come from. You are able to determine the capex you need to put behind, your operations. The capex to fund your operations, the capex you need to fund or put behind your local suppliers, because, of course, it is important that even with the stability, you should go local where opportunity exists as much as possible, so you are able to stabilize as much as possible. So I think it's a more better space. We are able to forecast. we're able to predict, and we're able to give to the consumer. I'm sure the consumers would know that the rate at which prices fluctuates now, it's not as what it used to be in the last 2 years. There's a little bit of stability. So I think it's a better space. Thank you.
All right, thank you so much, Mudukwe. Hugo Dre, I'll come to you now. And I'll say this. As much as we feel that there's still a bit of stability in the market, there's still one devil we are still fighting, which is the parallel market. Right. It looks as if as much as the CBN is trying to make the market more open, the parallel market still strongly exists. Now, what do you think is the impact of the parallel market on the manufacturer side and the general economy at large?
On the what?
On the consumer, the manufacturers, right? Sometimes they can't get what they need, so they have to go to the parallel market to get their needs. That definitely creates some sort of impact on them in terms of their planning and all of that, right? That's on one side. But also on the general economy, if we're unable to technically wipe out the parallel market, they would always be there. It's a market that, in your word, is for profit, as it were. So what do you think will be the continuous impact of the parallel market?
I'm not one of those who think that the parallel market doesn't serve any purpose. I think we need to also understand that we're not UK or United States or France. We're a third world country, and people would always need to access currencies, albeit informally. That's on one side. Secondly, let's also remember that we also have a BDC market, right? And so the Bureau de Change is a purely retail market that also plays in this so-called parallel market space, because a lot of the people who are in this parallel market space are licensed BDCs, right? So as much as we like to call it parallel market, it's essentially a retail market. The closest we got to maybe, having a parallel market that was less of an influence in the entire system was when we had the exchange rate at about 360 to the dollar. If you remember, then we had, a lot of all these retail FX platforms in Nigeria. Travelex, a lot of them were all, so you could basically just walk into the airport, buy FX, and then go. So if you don't have retail outlets where people can buy Forex, cash, then the parallel market would always serve that purpose. So even today, if you travel out of the country, US, wherever it is, they actually have retail outlets. There are shops that you can just walk into and then you buy FX. It's just that some of them are licensed and then some are actually not. Even in the UK, if you walk into a regular shop where they probably sell regular small size supermarket, if you tell them you wanted to buy FX, they will sell FX to you. So it's just that they're licensed. So they do play that role. And I guess for a lot of businesses, the most important thing is the disparity between the parallel market rate and the official rate. So long as that disparity is within, I would always say 5% band, but because of the sort of space we are in now, even under 10%, we can accommodate, but 5% is usually the ideal band. So long as we're within that band, I think businesses can plan with that. And then even consumers as well, because if an official market is going at, say, 1,550, you should expect a little bit of a premium on the parallel market because you don't go through the same rigor that you go through when you're buying in the official market. But in this space today, we've actually seen a situation where the official market is even more expensive than the parallel market, which you would say, well, looks as if the reforms are actually working. So I don't think it's a problem. Where you have that problem was before, when you had a very fixed exchange rate market, and then you had a parallel market that was more reflective of reality, and then you had all that arbitrage. And then what was happening is that you had some major players who had access to government, and they were going to buy at the fixed exchange rate and then essentially arbitraging on the parallel market and out competing people. Remember when I talked about competition, it was unfair competition. So that no longer exists. So I don't think it's much of a concern to, manufacturers or even product distributors as it was several years ago. So the game has essentially changed, and I think it's important that we understand that we're playing in a different, different game now, different set of rules, and so we should all just adjust accordingly. Thank you.
All right, thank you very much, Hugo Dre. As we begin to wrap up, I will go to Narendra now, and I know that this is going to be this is your forte. So, as FMCG brands bypass wholesale deals with pay after service, right? How will this disrupt distributor financing, and who now bears the inventory risk?
Again, this would depend on the segment that you're catering to. So if you're trying to bypass the distribution channel, but if you're looking at a mass product, I think it's difficult to do that. Because in the end, your mass products are made in big quantities, and the primary aim of the company is also to get back the funds. So in a way, for the mass products, it would be difficult, but when you look at slightly more premium or more expensive products, this could be probably looked at and done positively. I think that would be my answer to this.
Thank you very much. All right, maybe just one more question for you, Dukwe. So, in terms of local production, right, do you think there's been any trade-off, right, in trying to fix the price? Or do you think businesses have adopted a trade-off between quality and trying to have fair pricing?
Okay, so it depends on where we are looking at this from and then the strategy of the organization itself. Of course, when you're trying to localize or you're trying to transition your large portfolio to, having localized materials, it's how you then want to trade. What do you want to put on the table? It's the strategy that the organization wants to run at that point in time. Because, for instance, localization of your raw materials may not immediately give you the margin or the profitability you're looking for, because you would have to invest behind that project, support the suppliers. They may not be able to give you the materials in the right quantum, in the right quantity, in the quality that you want it. So you then have to spend a lot doing R&D, giving technical support and the likes. So the benefits, might be a little bit in the long term. So it depends on what the organization wants in the immediate. And as you have said, you don't run an organization just for the now. You have to look for, how you can sustainably run the business. So the benefits may not come in the now, but definitely as we migrate, which I see a lot of FMCG doing right now, trying to get a lot of, localizing a lot of their materials, investing here, within the West African region to ensure that most of the materials in which we import are now available locally. We are able to, of course, begin to see the profitability flow into, the financials, into the P&L for most of the FMCGs. If you look at the results, you would see that there's beginning to be some positive margins coming through and growth within the industry. So the trade-off is, okay, you may have to invest, you may have to put a lot of capital, put a lot of your time, but of course, in the long term, the rewards would come through.
Thank you very much, Budupe. Can we appreciate all our panelists? And with that, we've come to the end of the very first panel session. I think that the most important takeaway, right, for me, and I'm sure you would all agree with, is first of all to note that the regulatory environment has greatly changed. We are now in a more fluid environment, and it's not as it used to be. So you need to get more familiar with it. And most importantly, just like our keynote speaker said during his keynote, data will be the differentiator in this market going forward. Thank you very much and enjoy the rest of the session.